Jeff, let's move on to our next article. And this was written on August 5th, and you posted it at Alhambra Investments. And it was called Buckets and Toolkits, Each Are Empty. Why did you write it?
Well, again, we're talking about where is the economy going to go from here? Now, we all know that it was bad. I mean, we just went through probably the worst quarter in modern economic history, not just here, but almost everywhere. But that, it's not a surprise. Everybody's kind of factored it in. We've kind of come to peace with the fact that this is a really bad interruption in the global economy, in the U.S. economy. But what comes next? Is it going to be a full and complete recovery where after, a little while, a couple of months, we're right back to where we were before, and this is all just a bad memory? Or are there things that are there factors that will come about which will interrupt that kind of rebound recovery process and make this a prolonged period of economic agony? And that's what we're really looking for. That's, monetary policy and fiscal policy, both quote unquote stimulus policies, are designed and aimed toward making sure we have more rebound, less prolonged.
Well, then what might be in the toolkit? Or actually, let me rephrase that. What is perceived to be in the toolkit of our monetary technocrats to help lessen the downturn and quicken the recovery?
Well, you would think there'd be a lot of money in the toolkit because they keep talking about something called a printing press, which we're taught that the Federal Reserve especially controls and uses the printing press to whatever its designs or whatever its programs or whatever its policies might be, but they don't actually have it. So in lieu of actual printing press, because as our major premise here at Eurodollar University is that it's impossible to really define money. And these Eurodollars we're talking about are most often just a euphemism for bank resources, bank liabilities, bank assets, all the stuff that the banking system does, including derivative transactions. So in lieu of an actual printing press, what is actually in monetary policy? Well, believe it or not, it's an expectations policy, which means getting people to believe that they actually have a printing press and that they're using it. So what Jay Powell has on his side is essentially the entire financial media, which continues to write about monetary policy as if this printing press was actually a real printing press and not just to create the remainder creation of bank reserves. And he's also got this legend that we've all been raised with, especially people our age who remember Alan Greenspan in the 1990s, who was the legend, the maestro, the apex of the perfect Socratic technocrat, the most wise and the best, brightest, the guy who had the most ability, who knew what he was talking about, and then handed it off to other people like Ben Bernanke and then Janet Yellen, now Jay Powell, who have all followed in his legendary footsteps and are able and capable of doing all the same things that we've been hearing about from Alan Greenspan for decades upon decades now. So the Fed has in its corner the financial media, this myth, this legend, and the fact that because of all these things, everyone says that must be what's happening. And of course, human beings are not wired to believe that everyone is always wrong about some such big things. That's really what monetary policy is. It's essentially a religious cult-like belief system.
I remember that Ben Bernanke was also one of the members that mentioned the printing press, and I think he said it was that they could let it run pell-mell or higgledy-piggledy or willy-nilly. But is that actually happening? You show a couple of graphs right in the beginning of your article saying, I'm not so sure. And those were credit spreads of corporate bonds. It looks like they both have come down a bit from where they were earlier. When I say both, I'm referring to the kind of the safer corporate bonds and then the more risky corporate bonds. It looks like it's come down. So success?
Yeah, this is the other part of the current monetary policy program that's kind of new. And there's always got to be something new in the toolkit. Or at least that's the idea they want you to present you with. And the new part of the toolkit is essentially that Jay Powell isn't just going to print a lot of money. He's actually going to use this printed money, this printing press that he supposedly has, to support markets. And the reason he wants to support the corporate bond market in particular is because the corporate bond market was actually the epicenter of global financial crisis number 2, which took place in March, as you can see in the charts that we're showing you here. The spike in credit spreads, which is essentially those markets breaking down, was incredibly destructive because that's what linked to the repo market, the collateral side, which then caused the liquidations in all these global markets, including U.S. stocks, which everybody knows never ever go down. So Jay Powell has put it as an attachment to his printing press activity that we're going to support corporate markets because there's a need for us to support corporate markets. And all we've heard since March was that, number one, the Fed is going to be buying corporate bonds. Therefore, why would you ever fight the Fed? And number two, this flood of liquidity. Therefore, everything is perfectly fine. But when we look at credit spreads, what we see instead is, yes, they've come down by quite a lot, but they're still quite elevated. And they're certainly not down to where they were back in February. Like the dollar is still high. There are still pockets of angst and uncertainty that is causing markets to be still slightly dislocated, not quite on board with this. The Fed is supporting it and guaranteeing everybody.
Well, maybe they just need more time, I suppose, to settle down. But I don't think that's what you're driving at in the article. And you did write, quote, "The riskier the asset class, the more elevated. Underneath," and that's what we're trying to get at, is what is underneath these numbers? "Volumes have come in just the way you'd figure given the stubbornness of spreads, not normal." What do you mean by volumes have not come in normal?
Issuance volumes. The credit market has taken a step backwards. And the reason why is because the default volume, which is what I'm really getting at with that quote, has exploded. In fact, we're seeing in some of these buckets, the default volume is at record levels, or at least in all the buckets, it's back where it was in the worst days of 2009. So we're really starting to see what it is that has driven a lot of the angst in these corporate markets is, so Jay Powell's going to buy some ETFs and maybe some individual bonds. He's got a predetermined list that BlackRock came up with in conversation with a bureaucratic committee 7 weeks ago, and they're going to be buying these bonds all along. But that doesn't solve the underlying problem, which is we may have a solvency problem, which is defaults, losses, credit problems.
And doing us a favor is Fitch, the credit rating agency, and they recently came up with an estimate for this year and next year, and they estimated that they are expecting to see 5 to 6% in 2020 of corporations going or defaulting on their bonds, and then another 7 to 8 in 2021 of around 15% in total. Jeff, is that a lot?
Yeah, that's an enormous amount. And let's be clear, we're talking about the high yield bucket. But that's an important part of the market because in a liquidity environment that isn't the way that it's being talked about, as we saw in 2007 and 2008 with subprime mortgages, the issue wasn't the solvency, the credit problems in the riskiest parts of the system. It was how those questions about collateral and transformation, all these other things, transmitted into other parts of the monetary system. That's exactly what we saw in March. What we had was a liquidity breakdown based upon potential, market agents starting to think ahead of what if we do have a credit problem? What if we do have credit risks? How do we handle them ahead of time? What we saw was essentially dealers simply stepped away from all markets. That's why you saw credit spreads explode for pretty much every category. It wasn't that people are worried about Walmart defaulting. It was the fact that the minor thought that maybe there's a credit problem in the high yield stuff, the worst junk kind of corporate bonds, maybe that's going to spill over and it just becomes a monetary snowball where questions don't get answered, and that it becomes essentially a liquidity vortex, a vicious cycle where one thing begets another. And the idea was that under monetary policy, by the Fed supporting the corporate bond market, or at least portraying itself as supporting the corporate bond market, that would interrupt all of these negative feedback loops in the vicious cycle. But what we're seeing, especially in elevated credit spreads, is, maybe it's convincing some people, but there's still a lot of questions out there.
Jeff, so the Fed is supposed to be supporting the corporate bond market by buying some of these bonds, and that's supposed to filter down through the rest of the credit tree. The Federal Reserve does do a survey of loan officers about the real economy, not the market, but real loan, well, at least that's how I think of it, the real economy where bankers are making loans to businesses, commercial real estate, residential mortgages, industrial and commercial loans. How does that survey look right now? What are the results telling the Federal Reserve?
Yeah, I think in terms of the way the Fed prioritizes its goals and its aims, it's actually more aimed at what you were just talking about, banking and lending and that kind of thing, than it is the junk market. I mean, they're using their support in the junk market to transmit a message to the entire banking system that says, hey, the stuff that you saw go nuts back in March, we've got that covered. Therefore, you've got nothing to worry about. Plus, we flooded the world with dollars and liquidity, therefore inflation. So you better start making a bunch of loans today, and that will get the economy back up, or what John Maynard Keynes used to call pump priming. That's really what the Fed is doing. It's using these expectation-based signals to signal to the banking system to go back to normal. And even, with inflation expectation, or at least the inflation expectations the central bank wants to create, not just go back to normal, but you better get going with lending because we got inflation coming. And so, they really are prioritizing their signals to the banking system because lending still is the basis of much of what goes on in in terms of economic activity.
And the results, though, the survey, though, well, how does that look?
Yeah, we're talking about the Senior Loan Officer Opinion Survey, which the Federal Reserve conducts quarterly. And what you find is that even worse than you see in credit spreads, the banks, the senior loan officers across all of the categories, which include, as you pointed out, Emil, we're talking about commercial industrial loans, commercial real estate loans, residential and commercial mortgage loans, as well as consumer loans. The banks have said, no way, we're not buying any of this. What we're actually doing is we're reacting very harshly, very pro-cyclically, in that we're going to be cutting back. We've tightened our lending standards. That's really what the surveys show you here, is that banks have so tightened their lending standards that they're essentially telling the Fed that the number of potential borrowers who are going to qualify for loans have been so restricted that it's, the level of lending is going to have to adjust lower because of it. So the message the Fed is attempting to send to the banking system is not being received by the banking system at all in the same way. In fact, as I think I wrote in the article, the banks have told Jay Powell to stick it where the sun don't shine. They've looked at the economy, especially the labor market, especially the way, the way the business sector is going right now. Questions that abound are there. The potential for, further economic consequences and the fact that so much is uncertain. And they've said, we don't care what monetary policy is. We don't care about inflation, this promised inflation from the central bank. We don't care that they're buying a bunch of corporate bond ETFs. What we're seeing is instead a complete and utter mess. In fact, it's such a mess, we've only seen this once before. And that was the Senior Loan Officer Survey for October 2008. So after what we're talking about, 3-4 months of monetary policy, 4 months of monetary flood and markets being supported and the stock skyrocketing, especially the NASDAQ, the banking system itself is saying we haven't seen anything like this since the fourth quarter of 2008.
Jeff, final question for me. What about the idea that government will start guaranteeing some of these loans that the banks make? There's been some talk about that. And you say in your article that that's not going to be quite the solution people think it is.
Well, it sounds like it should be, right? I mean, if the banks are concerned about, hey, we make some loans and it turns out that was a bad loan, if the government steps in and says, well, we'll guarantee all the loans, well, that should be problem solved, right? But, it's never that simple. And I run across this all the time. We saw, just talking about how the Fed is supposedly supporting markets. On the surface, it sounds like the Fed is supporting market, but the Fed is actually just buying certain stocks, certain bonds, certain ETFs. It's not at all the same as supporting a market. They're just doing some things that people characterize as supporting a market, and it's sort of taken that way. But when push comes to shove, the corporate bond market is still as vulnerable as it ever was. It's just creating a myth of support. The same thing with loan guarantees. I mean, we had loan guarantees on subprime mortgages, on prime mortgages too, back in 2007 and 2008. And what happened with those guarantees is it created an even bigger problem because it infected the GSEs, who contributed mightily to especially the second outbreak in September of 2008. But more than that, I mean, what we're really talking about, what the Fed wants to accomplish, is it wants to get banks to extend new loans. And a bank is not going to knowingly extend a new loan to a person it knows it's going to default. The person to a borrower it knows is going to default. It doesn't matter if the government guarantees it or not. You're not going to lend to somebody who's not going to pay you back. And what is the bank going to carry a non-performing loan on its books for many months, and then hope at the end of it some bureaucrat approves that this is a loan worth being guaranteed? It's way too much trouble. It's way too much uncertainty. It's way too much of a negative pressure for them to make an existing loan based on a loan guarantee. It's just not going to happen. Banks are going, and what the senior loan officer opinion survey is showing you is that, no, we don't care guarantee, market support, monetary policy, whatever it is, we're not going to lend the way we used to lend. That's the bottom line message that the banks are sending to pretty much anybody who wants to listen.
Well, this section of our show was sponsored by social media. So if you want to support the show, go find Jeff on Twitter, subscribe to his feed. You'll find him at @JeffSnyder_AIP. You'll find me at Emil Kalinowski, and search for this show on YouTube and with your favorite podcasting provider.